Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is Your Money, Your Wealth.
Hey, welcome to another edition of Your Money, Your Wealth. Thanks for joining us. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with, of course, the big man. He's sitting right over there. It's Big Al Clopine. He's a CPA. First time watching the show, I'm a certified financial planner. I've been doing this close to 20 years. Big Al has been practicing, helping you with your taxes for about 200 years. So we're going to talk a lot today about taxes. Can you believe it's already almost close to the end of the year? And so this is the best time to think about taxes, because I know we pay a lot in taxes, but if you look at the history of the tax code, we're in almost all-time low rates. Where do you think tax rates are going to go? I think everyone agrees that tax rates can only go one way. So stick around for this episode to figure out ways that you can still reduce your tax budget. So here's what's on my mind today. There's a lot of different things that we're going to get into, but first and foremost, there's two terms I want to explain. There's tax avoidance and there's tax evasion. All right, tax evasion will put you in jail, so we're not going to go there. Tax avoidance is your given right as a U.S. citizen to do everything you possibly can to avoid the tax bite. There's a quote that I want to talk about by a good old judge that he spoke with a few years back. It might have been back in the 30s. And he's basically saying you can arrange your affairs to do everything possible to reduce the tax burden. There is no patriotic duty to pay more money in tax. I'm paraphrasing, of course, but that's the deal. It is our given right to do everything we can to do what we can do to reduce the tax bite. Here's another problem. That's why I want to bring Big Al in, is that the IRS, the tax code, doesn't tell us what we can do. So there's no roadmap to say this is exactly the strategy fit for you. The IRS code tells you what you cannot do. So it's your interpretation of the code to make sure that you apply it to your specific situation to do everything you can to reduce your tax bite. With that being said, let's bring in the big man, Big Al Clopine. How'd you like that quote, Al?
Well, I love that quote, and I think this is maybe going to be one of our best episodes ever, because you think about tax planning, and what can you do to reduce your taxes? And I think all of us would like to pay less taxes. In fact, I have yet to find a person that said, you know what, Al, I think I'd rather pay a few more taxes. No, y'all want to reduce your taxes, and we're going to talk about how to do that on this episode. And now is the best time, really, because about 95% of the strategies you have to do this year. So when you consider year-end tax planning, a couple things. First of all, you have to understand your income tax bracket. You have to see what tax rate you're paying to figure out what strategies are going to be the best for you. And in many cases, even most cases, you want to try to reduce your income to try to reduce your income taxes. But in some cases, you might actually want to increase your income if you're in a low bracket year, and we'll get into when and why. But Joe, I think this is the time of year. I mean, it's Thanksgiving, it's the holidays, but it's also the time of year to make some changes to put yourself in a better position tax-wise.
Well, you know, it's kind of funny. We're talking about tax planning, right? And so you would think, okay, let's figure out some deductions, exclusions, exemptions, tax credits, or whatever that you can do to reduce your overall taxable income. But wait a minute, you said that you might want to increase your income.
In some cases.
And here's the reason why, because the whole dimension of the tax code has changed significantly. If you take a look today with the different taxes that just came about with the new tax bill that was signed in 2013, with the squeezing of your deductions, tax rates went up when it comes to capital gains, your ordinary income. Everything has changed a little bit. So it's not looking in the rearview mirror anymore. It's taking a look at, all right, well, what can I do today, but not ignore tomorrow, 5 years, 10 years, 20 years down the road? Yeah,
I think that's well said. And really, in a lot of cases, what happens is people are trying to reduce their taxes so much today that they actually want to, they're going to be in a higher tax bracket later. And so you have to consider multiple years of taxes, not just 1 year. But let's start with how the tax brackets work. And I think we have a slide as the brackets. And this is married filing joint. And what you can see is from your first $0 to $18,000 of income, you pay 10% tax. Above that to $73,000, you pay 15% tax. we have a marginal bracket, which means no matter what bracket you're in, you will still get the benefit of those lower brackets. So look at that 73,801. That's the start of the 25% bracket. If you make 73,802, it's only $1 taxed in that 25% bracket. This is what accountants call marginal bracket, and it's important to know your marginal bracket because when you're adding income or you're deducting income, that's going to be your detriment or your savings. If you're in a very low bracket, you might actually want to increase income so that you're not in higher brackets later. But in many cases, you're in a high bracket, you want to go just the opposite.
Right, you want to take a look at what tax bracket that you're in to determine what type of tax planning is appropriate for you. And so looking at those brackets, going back to your tax return, you can say, all right, looking at line 43, second page of your 1040, that will tell you what your taxable income is, line 43. Then you can say, all right, well, this tells me what tax bracket that I'm in. Am I in the 15, the 10, the 25, the 28? Did I fall into alternative minimum tax? And that's a whole different topic, a whole different show. But there's ways then that you could say, do I want to increase my income this year or do I want to decrease it? Let's talk about decreasing your income, Al, and figure out some strategies of what people can do now, I guess, for the next 4 or 5 weeks that they still have a little bit of time.
Well, I think that's important. I think that's what really most of us want to learn about is how to decrease our income. So let's get into some of those strategies. So number one would be make sure you're maxing your 401k or 403b, whatever kind of employer plan that you have. The total is $17,500 this year or $23,000 if you're 50 years and older. You only have a couple months left, but try to max that out, or at least as close as you can between now and then. You may have to change your payroll deductions, maybe go to HR to make that change. Here's another one. You might be getting an employee bonus, and you might ask your employer, can you defer that bonus to January so that you don't have to pay taxes on that this year? So that's a second thing that you can do. Now another one, let me go to my list here, would be if you have appreciated stock. And
right, so you want to look at tax loss harvesting. And if you have mutual funds, here's a pretty big deal this year because if you look at the stock market over the last several years, there's a lot of gains. And these portfolio managers inside your mutual funds have been selling stocks at gains. We're going to see a lot of taxes on individuals' tax returns because of how mutual funds work and how they're taxed. So you might get hit with a huge capital gain tax this year. So some of the things that you want to take a look at is if you have losses in other positions, other stocks, bonds, mutual funds that might have gone down in value, you might want to sell those positions to create a capital loss to offset that capital gain, so to zero that tax out. This is a huge deal. You still have some time. I know the markets have done pretty well, and I know all of our viewers, they're great stock pickers and great mutual fund pickers. But if you do have a dog or something that has gone down in value, you want to make sure that you take a look at selling that, because what that's called is tax loss harvesting. You're selling some of those assets to offset the capital gains that I know is going to hit a lot of your investments coming up here on April 15th. It's too late. You've done your taxes. You're going to see this huge capital gains tax, and there's nothing that you can do. So you've got to get it done before year end.
Yeah, and I think a lot of people don't realize that when you have a capital loss, it offsets against capital gains dollar for dollar.
Yes, so it doesn't matter if it's short term or long term.
Right, right. So that's very effective. I want to just quickly touch on another one, which is charity, charitable contributions. Realize that you have to make your donations by December 31st for them to be deductible in this year. But here's a couple things that you may not know. You're allowed to donate appreciated stock, which means maybe you bought a stock at $1,000, now it's worth $10,000. You donate that stock, you get a $10,000 deduction, what it's worth today, but you don't pay any tax on the gain. And there's also this account called a donor advised fund that allows you to take future year contributions and deduct those this year. You put money into this special account, you take the deduction this year, you let it grow for as long as you want, and then charity, you give it to charity later on as you want to.
It's a big deal. There's a lot of different things that you can still do. You still have time. So if you have stocks, bonds, mutual funds outside of your retirement account, and you will get kicked out with capital gains, interest, dividends, you want to make sure that you look at losses to offset those gains. If you're giving to charity, give to charity before year end to get that tax deduction on your tax return this year. It's going to help you quite a bit. We're going to take a short break. When we get back, I'm going to draw a couple of things out just to look at a case study of how much money that you can actually save in taxes just by doing 2 or 3 of these things that we just mentioned. So don't go anywhere. The show's called Your Money, Your Wealth.
I'm Matt Horsley, certified financial planner with Pure Financial Advisors. Did you know if you retire today at age 65, your healthcare costs are likely to be roughly $250,000 in total? That's roughly $13,000 per year throughout your retirement.
Hey, welcome back. The show's called Your Money, Your Wealth. Thanks for tuning in today, talking end-of-year tax planning. It's not too late to save significant money on your overall taxes, but you have to do the planning. I know the holidays are coming up. Thanksgiving's right around the corner, and then everyone kind of forgets about it, but do not do it. You still have time to put money into your pocket versus Uncle Sam's. That's the best gift that you can give, right? More money to you. Let's go to the true-false question to see where we're at there.
If I donate appreciated stock to a charity, I can deduct the value of the stock on the date of the donation and avoid capital gains taxes.
No idea.
And the answer is absolutely true. In fact, we just talked about it last segment, so this will be a good reminder. When you are donating to charity, you actually get to deduct the value of the stock that you're giving, right? So
if you bought it for, let's say, $1 a share, it's worth $10 a share right now, then I donate that to charity, then I get the $10 per share deduction.
Yeah, and even better yet, you don't have to pay the tax on the $9 gain, right? So you get the full deduction without paying the tax.
Well, and the problem is that people give cash, right?
Yeah,
so let's say, here, I want to give a $10,000 deduction, so I'm just going to give the charity cash from my checking account. Well, give $10,000 of appreciated stock. So you give the stock to the charity, they pay, or they'll sell the stock, and they don't pay tax, you don't pay tax, so it's a win-win.
Yeah, it really is.
And you get the deduction.
It's a good way to go. Now, a couple quick things to be aware of. You're limited to 30% of your income. So if you make $100,000, you can't give away any more than 30% if it's stock related. But the other thing to realize then is you have to do this by December 31st, and there is most all charities will take stocks. They're happy to do it. They're very happy to do it. Now, contrary to popular belief, the tax rates are actually at almost all-time lows.
One of the things I wanted to learn how to keep our money is a big deal.
Kelly wants to retire sooner rather than later.
I travel all over the world, and it's getting really tough on my body and things to do that.
She's attending classes at Cuyamaca College to learn tax strategies to save even more money. But what she doesn't know is her federal taxes are already at historically low levels, according to the Congressional Budget Office. The CBO just published its annual analysis of Americans' income taxes. According to the analysis, the average household pays 19.3% of its income in federal taxes in the U.S. 60% of families pay just 13%. Tax rates were about 6 percentage points higher back in 1979. So why doesn't it feel like you're getting a break? Even though federal taxes have fallen, incomes have stagnated, and when you consider inflation, most middle-class families have experienced declining standards of living over the past 7 years. Still, when you consider taxes across the board in the U.S., from income to sales taxes, Americans are getting a global bargain. Americans have the fourth lowest tax burden of 34 developed nations, according to the Organization of Economic Cooperation and Development. Kelly says she'll use whatever tax strategy she can to save additional money. She's a long way off from the number she needs to retire.
I was thinking about $3 million needed to be in there.
Well, Al, I mean, like you were talking about, tax rates are historic lows. And so when people, I mean, I get it. We're paying a lot in taxes. But if you look at the history of the tax code, I mean, when you started your career back in the 30s, I think the top marginal rate was, 90-some-odd%?
Yeah, that's what you like to say. I actually started my career in the 80s, but at any rate, but yeah, even though tax rates may be lower than most developed countries, we still want to save money on taxes, and I think we have a really good case example on how to do this.
Al. Let's talk a little bit about just a simple case of what you can do to significantly reduce your tax bite. So here's baseline, all right? So let's say there's a couple that make about $180,000 a year. They have some mutual funds and stocks and bonds outside of retirement accounts, and then that kicked out about a $30,000 capital gain. Then they have, all right, some Social Security of another $30,000. So their adjusted gross income is $240,000. So then they have deductions, exemptions of another 20. So you get their taxable income of $220,000, AMT tax they fell into because of their income. Their tax is $52,000, 52 grand. Let's just do three quick strategies. Now, let's reduce their income because they can contribute into retirement accounts. So let's say they put $20,000. So we reduce that from 180 to 160. Now, because we can do some tax loss harvesting before year end, like we talked about, sell some individual stocks or mutual funds that are down in value to offset those gains, we're able to do that to zero that thing out, zero it out completely. Then we're going to give a little bit more to charity this year because they're in a larger tax bracket than normal. So we give a little bit more to charity. So from $20,000, we're going to give $50,000 in what is called a donor advised fund, so we can front load those deductions. And then now look, we get their taxable income to 140. Now they're in the 25% tax bracket. But here's the biggest thing: 26,000 to 52. We cut their tax in half. 3 simple strategies to save about $25,000 in tax, and you can still do this. It's just taking a look at your overall situation. Al, I mean, we look at this all the time, and there's still opportunity for people to reduce their tax burden.
Yeah, there are, Joe, and it's just a matter of knowing what you need to do before year end, and in some cases even little things like paying an extra mortgage payment or prepaying an extra property tax payment and so forth. But here I want to switch gears a little bit because, as odd as it may seem, in some cases you may want to increase your income because you're in a low tax year. Maybe you lost your job, maybe, so you have lower income, or maybe you have a business where you lost money. Maybe you have like a net operating loss carryover from a prior year, or maybe you actually sold a rental property at a loss, and that qualifies for what's called a Section 1231 loss, which means it's an ordinary deduction. So you can take that loss against any other income. So if this is your case, if you're in a low bracket this year for a variety of reasons, then you may want to look at actually increasing your income. And a couple thoughts there is maybe you want to try to advance, like if you're going to get a bonus early next year, maybe try to receive that this year. Maybe you exercise some stock options to be able to create some more income, or maybe you sell some stock to create some income. If you have a 401k, 403b, maybe you switch to a Roth contribution rather than a regular. And a Roth conversion could be an ideal strategy for you. That's taking money out of a regular IRA and converting it to a Roth, which will grow 100% tax-free in the future. You will pay tax on the conversion amount, but if you're in a low bracket, it's a low tax to pay.
Here's the biggest mistake that we see from individuals such as business owners that might not have a great year, or maybe they have a lower income year. So let me give you another quick example. So this is case study 2. We want to increase income. And Ty, do you see how big this is? That's very large. It takes up the whole screen, just FYI. Okay, so let's say their salary, is $20,000. All right, so they own a business and they have some business losses of negative $50,000. So they're just saying, all right, well, here, I'm not paying any tax. I had a bad year. My taxable income or adjusted gross income is negative, so I'm not paying any tax. Life is great. But often we see this where they're losing a huge opportunity now to add income to their tax return and not pay any tax on that, such as taking money out of your retirement accounts, your IRAs, your 401ks, your 403bs, TSPs, whatever it is, taking money out of those accounts and converting those into a Roth IRA, so those dollars will forever grow tax-free. It's a huge deal. It's really parlaying your wealth. So now let's look. 20,000, everything's same. 50,000 business loss, right? So now we do a $120,000 Roth conversion. You take $120,000 out of the retirement account, you move it into a tax-free position. Now that 120 will grow tax-free forever. So then their adjusted gross income increases, of course, to $90,000 because we added $120,000 of income. But catch this. This is the number that you want to look at. How much tax is it going to take you? $10,000 to move $120,000 into a Roth IRA? This is the biggest no-brainer. Absolutely, you have to take a look at your tax return before year end. So if you have lower income, this is a great opportunity for you to parlay a retirement income tax-free for a very, very long time. Huge, huge opportunities. You still have time to do it. So make sure that you look at your tax return, sit down with your CPA, sit down with a certified financial planner, coordinate everything to make sure that you're doing everything correctly and appropriately in the next few weeks. All right, with that being said, we got a quick break to go to, and then when we get back, we got your email questions, we got some more cheesy commercials, we got a whole gamut of good things to go. So don't go anywhere. Show's called Your Money, Your Wealth. Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. We're talking taxes today. End of year tax planning strategies that you want to make sure that you do before year end. You still got a couple of weeks to save a lot of money. Or let's go to the true false. Let's just go to the true false right now.
That is a great idea. If I convert $50,000 from my IRA to a Roth IRA, I'll pay tax on that amount, but all future principal, income, and growth will be tax-free.
Yeah, well, that's absolutely true, Al.
That is true. And I will tell you something, this is really one of the best techniques, or best strategies, I should say, that the IRS has given us in years. And so here's the strategy, which is you can take some of your IRA, 401k, 403b, and you can convert it to a Roth, and that just simply means you take it out of your regular retirement account, put it in a Roth account. A Roth account grows tax-free. All future growth, income, and principal is tax-free. Anybody can do it, and a lot of people don't realize this. 2010, they took the income limitation away so that anyone can do the conversion at any income level. It doesn't matter how old you are. It doesn't even matter whether you're working or not, and you can do any amount. You can do the whole thing, or you can do part of it.
And one of the biggest things with that, it's called tax diversification, right? So if you think about your portfolio, right, you have stocks and then you have bonds. And so stocks do very well, right? Then you're like, man, I wish I didn't have bonds. I wish I had everything in stocks. If stocks go down, you wish, man, I wish I didn't hold all these stocks. I wish I had bonds. Same with your taxes, because what we're finding is that all the money that is held for your retirement, in most cases, are sitting in a retirement account that will be taxed at ordinary income rates. Wouldn't it be nice for you to grab a little bit of money tax-free? So the concept is called tax diversification. Even though you're paying a little bit more tax now, but you're even out the tax burden or potentially reducing your taxable income significantly when you need the money the most, and that's in retirement. Let's go to the, you know what, let's just jump into the emails. We got a few emails. We haven't answered a ton of emails lately, so let's go to the email questions. What's the first one?
Yeah, the first one is from Pete in Vista. He says, I have a landscaping business that is showing good profits this year. What are my options in setting up a retirement plan for my business?
Well, there's a lot of things, right, Al?
There is a lot of things, and let's just jump right in. The first thing you can do is what's called a SEP IRA, Simplified Employer Pension Plan. This is something where you can contribute up to about 20% of your income, or 25% of your salary if you're incorporated. That's the easiest one. You can set that up all the way into the filing date of your tax return next year. Some of these other plans, like a simple plan, 401k, defined benefit plan, need to be established this year. A couple of them are too late already. The simple is too late, regular 401k is too late, but if you have a business that has no employees, you can still set up what's called a solo 401k for yourself by December 31st and get a lot of money into it. Same with
if you're a small business owner, I would highly encourage you to take a look at the solo 401k, because you can set up your own 401k plan. That's why hence the solo 401k.
Right.
There's not a lot of costs, there's not a lot of fees, there's not a lot of expenses to this, but you can shelter a lot more money into the solo 401k potentially than you can in the SEP plan. The defined benefit plan is the grand poobah of them all, that you can shelter several $100,000 away. So you just want to take a look at how much money that you want to shelter. If it's about $50,000, then the defined contribution plans is your best bet, such as the 401k, solo 401k, SEP plans. If you want to shelter a lot more money than that, then you want to look at the defined benefit plan. But you have to still do it before year end, so you got a few weeks to get it done. Let's go to the next question.
All right. I've heard that you can invest in oil and gas ventures and receive a huge tax benefit. Can you comment on this? This is from Calvin in Rancho Santa Fe. And the answer to that question is yes, you can do that. Many of these ventures, they're private ventures drilling for oil. You invest $100,000, you may be able to write off $70,000, $80,000, $90,000 all in the first year. But be careful, these are not necessarily the best investments. But
it's wildcat, right?
Yeah,
it's very, very risky, highly speculative,
yes.
And you have to be an accredited investor. So this is not for everyone. So I guess to answer your question, just from a compliance standpoint, yes, it will give you a tax deduction, but be very, very careful going into these type of investments, because in most cases, it really potentially can help the agent that's selling it to you, because they talk about these great tax benefits and also these great returns. But be very, very careful when it comes to those types of speculative investments. Hey, that's it for us today. Hopefully you enjoyed the show. Next week, we're still going to dive in. There's still more strategies that you can do before year end, so we want to give you some more tidbits before it's too late to put more money back into your pocket. It's the best give you can give yourself, right? Less money to Uncle Sam legally. Right? It's not tax evasion, it's called tax avoidance, and we're trying to give you all the tools and the nuggets that you need to avoid your taxes as best you can. You just have to understand the law, and that's what we're trying to do. Thanks for joining us. For Big Al Clopine, the big man, my name's Joe Anderson, and we are done. You just watched Your Money, Your Wealth. We will see you again next week. Have a wonderful weekend.